Intuit is one Cathie Wood stock down 36% that I think you might regret not buying on this dip here. Of course, Intuit is one of Cathie Wood's holdings in her ARK portfolios. It ranks number 54 on her list of over 120 stocks in a relatively small 0.24% uh, uh, percentage in the overall weight of her portfolio. Nevertheless, she does like this stock, otherwise, it would not be in the portfolio. And I agree with her on this pick. I like this stock too. And in this video, I'm going to talk about why. So, starting with very nice revenue growth, looking at the company over the last 5 years, over the last 10 years, you could see revenue has expanded from more than $3 billion dollars all the way up to $13.68 billion dollars. Of course, the tax preparation software has invested in other areas as well, including the app. Financial budgeting apps and others, and it's really in a good position here for the long run. I don't think tax preparation is going to get any easier in the near or long term. And so it's in a good position here to capitalize on that market. It helps mostly small businesses, entrepreneurs, self employed individuals who have a bit more complicated tax preparation schemes than do your everyday workers with the W 2 that have a more easier, less complicated tax filing process. So it's done really well, and I think it's got good prospects in the future, especially if you look at the operating profit, operating income trailing 12 months, 2.666 billion in operating income on revenue of 13.68 billion. So a nice profit margin, billions in operating income. So the business is not just generating rail sales; it's generating good income and excellent cash flow from operations. Look at this. Over the trailing 12-month cash flow from operations, $4.271 billion dollars, and that's been moving nicely higher over the last 5 years. If you're wondering why cash flow from operations is higher than operating income, it's it's because many companies have a lot of non-cash expenses, things like stock-based compensation, depreciation and amortization, and those things are non-cash expenses, but the company has to account for it on the income statement. So it it brings down operating profits, but since it's non-cash, it doesn't bring down cash flow from operations. So this happens because the way our accounting system works, if a company like Intuit, let's say, pays $100 million for an office building, it can't just put down $100 million of expense in the year that it bought the office building. There is rules with how it depreciates that office building. I think for real estate office buildings, the depreciation period is 30 years, if I'm not mistaken, or 39 years. Um, Correct me if I'm wrong. If there's an accountant in watching this video, correct me about the real estate depreciation time period. But what Intuit has to do then is take that $100 million and depreciate it over 30 years. So it takes a 1/30th expense this year, 1/30th next year, and the year after, all the way 30 years depreciating that expense. So even though it paid 100 million up front, it's not 100 million cash expense. And so because of that mismatch between cash outflow and the way it's accounted for on the income statement, you get this mismatch between cash flow from operations and the operating income. Nevertheless, it is a good sign to see cash flow from operations rising in this manner. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the last reason why I think you might regret not buying this Cathie Wood stock on the dip is because of the reasonable valuation. It's trading at a forward price to earnings of 32.19. That's down from a peak of about 60 it was trading for early in or late in 2021. So you're getting this stock at near the cheapest it has traded for in the last year and a half. And you're getting a company that's boosting its cash flow from operations robustly, boosting its revenue, increasing its operating income, and it's in a business that has some stickiness to it, right? The taxes aren't going anywhere. Taxes are not likely to get easier to do, and Intuit is in a relatively good position in that regard where it generates its revenue and profits. All right, so that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership. I hope you'll come back again soon.